Patrick. We were talking about the portfolios earlier. We came across this simulated CDs. Patrick had asked, is there a strategy called simulated CD, or is it another name for this strategy? It's another strategy, not related to the married put position, in the sense that the simulated CD, Patrick, is a covered call approach. It's not related to the married put in the sense that it's not a stock and put combination where you actually have a guaranteed limited risk of single-digit percents, unlike a stop order, which is assumed insurance. The simulated CD is a covered call approach. Let's go to the search tool. And of course, this illustrates where you can change the columns and pick and choose what you want to view in the search. That's a concept that we're looking at maybe for the portfolio tools, David. All right, but for Patrick, hey, we've got covered calls. What are we looking at here? I'm looking at the basic initial values default screen at the money. ELF at 66.84, slightly in the money, 65 call, 12.8% downside protection. What's downside protection in a covered call? Well, it's essentially the premium I received, let's take midpoint at 853, divided by my stock price. This 12.8%, 853 against 66.84. How far can the stock drop before I'm technically losing money in my position? How far is it to break even? That's what the downside protection is showing you. Percent if assigned, stock stays above 65. We make 11.5% in 42 days. Look at June expiration. This is the monthly, and ATM initial values is looking at monthly expirations. We have weekly searches there as well. 53.9% probability assigned, IV over HV, and other criteria. And of course, as I mentioned, that's our default criteria, but you can make any changes to the 20 to 30 different option criteria that are available, implied volatility ranges, percent returns, in or out of the money, bid price, bid-ask spread limitation, delta, Black-Scholes ratio, liquidity, volume, open interest, put-call volume ratio, percent current option volume, which you can do in the long calls and long puts, looking for options today that are showing an increase in percentage option volume compared to their 90-day average. All right. Monthly, default covered call screen you can customize as you want. Our other defaults are marked by the asterisk, just in the money covered calls monthly with better protection. Monthly picks of the day, our preferred search that's shown on that default pod that we had earlier, the picks of the day, out of the money, weekly picks of the day, and simulated CDs. Simulated CDs, more than 600 results. So what am I going to do here? I am going to increase my downside protection to 20%. Increase my percent if assigned annual to probably 10% as well, with volatility being so high. I should only do one change at a time, but let's go ahead and run that. There we go. Simulated CDs. Not quite. We showed earlier about that when we were going through the webinars about that fire and forget trade there. They're not really any fire forget trades, but this is one example that we showed up, the simulated CDs. I'm actually going to use Tidewater. All right. This is a screen for far out in time, deep in the money covered call position. These are too far out. I'm going to limit this to the standard January instead of 616 2 years out in time. Let's take a look at one first. Let me not get ahead of myself. Let's actually take a look at one. Here's a position out 616 days out in time. Tidewater is currently trading at 41.45. We could sell the 2027 in the money January 35 call for 16.10 at midpoint. All right, maybe we only get 16, maybe we only get 15.80, but hey, we're going to get at least 15.70. We're looking at a position for 616 days that has a 38.8% downside protection. The stock can almost fall 40% or $16.10. You know, we're talking roughly down to $29 per share before we're losing money on the position. In 616 days, if we're assigned on this position, I apologize. Yeah, oh no, 38% at midpoint. Okay, downside protection annual because it's 616 days out is a little bit lower. But for the whole term of the trade, 660 days, 38.8%. The stock stays above 35 in 616 days, roughly a year and a half, right? About that. So 38.1% return. That's an annualized return at midpoint of 22.6%. Now, it's got a 58-60% probability of being assigned. But again, 38% downside protection, 38% return if assigned for 616 days. Annualized downside protection, 23. Annualized return, 23, roughly. That's the simulated CD approach. Deeper in the money, far out in time. You check this maybe every quarter just to see where it is every 3 to 4 months. This is a popular structure used by brokers who use our tools, who have multiple accounts they're trading for. They'll do 1 year out standard collar positions, selling an at the money or maybe slightly in the money call, buying an out of the money put, showing their clients, that, hey, look, right here, I just generated 4% for you in premium. I gave some of that back for the put. You could make 8% if you're assigned in 200 days. The worst you could do is lose 4%. Don't have to look at that's all they have to show them when they walk in. They've got 10 positions, 8 positions open for them for 12 different clients. Why does that benefit the broker? They don't have to look at this for another 3, 4, or 5 months. They just leave it there. The market drops as it did. Oh, don't worry. The market's down 6, 7%. You're only down 2. That's their job. Calming, comforting, things of that nature. We like to take things in our own hands personally here at Power Options, as you guys do as well. But that's the idea. Now, let's cut this short a little bit. Not the conversation. Let's cut this time frame short. Let's just go 300 days out. Let's isolate to our January 2026 expiration. There's still reasonable positions in that time frame. Absolutely. Elf Beauty, we looked at that one earlier, 66.84. Selling the January 55 call for 2026, 258 days out in time. What have I got? 34% roughly downside protection. Percent if assigned in 252 days, 24% roughly, as long as ELF stays above $55. Is it completely fire and forget? No. But I just leave this there. 250 days from now, about 3/4, a little bit less than that of the year, 24% return, 33.6% downside protection. Check in on it every couple of months, maybe. Check in on it around earnings, see what happened, up or down. Do I need to roll this call down? Hey, could I even roll this call up and maybe increase this percent if assigned a little bit more? Pros and cons, what happens there? Vertiv Holdings took a big dip recently, if I'm not mistaken, but we're at 94.06. The December shorter term, 224 days out, December 77.5 call, 27.55 premium, almost a 30% downside protection for 224 days, 17% return as well. So it's just a covered call. But the idea there is that it's deep in the money, giving a double-digit downside protection, double-digit percent return if assigned for 8, 10, 12 months as well. Check in on it occasionally, check in on it around earnings, set an alert to be notified when you're 2 to 3 days before earnings, see where the position is, check the day after earnings, see where the position is, not rolling, not adjusting, not managing. Of course, yes. By doing this, if I took Vertiv at 94.06, not a recommendation or suggestion, and I sold just the 92.5 call, maybe there's a 93 or a 94 call with a weekly expiration, and I did that week by week by week by week by week, I'd have a higher potential for a higher annualized percent return, selling week by week, month by month, than going far out in time. It's not fire and forget, but hey, stock can fall almost 30% before I have to worry about losing money on the trade. You still make almost 16.5%, 17%, as long as the stock stays above 77.5 for 224 days. Much more relaxing, much more calming. Not as calming, not as relaxing as the married put structure, where I know in the worst case scenario, I can only lose 4, 5, or 6% on the position, even if there's a complete market collapse, which we're not looking for, we don't want to see, but that can happen as well.